All right, hello everybody. Thank you so much for tuning in on your Friday night here, Friday evening. I guess it all depends where you live. The stock market jobber has members of our community all over the world. But anyway, I mean, just because I live in Connecticut, we're based in New York City time. But all right, let's go through the markets because you're probably sick of hearing where I live and you want to just know how you can make some money. But in our community, you got to be friendly too. But once again, I mean, literally, there are very few times where there's like one thing in the market to watch. You know, maybe once or twice a year. Usually, it's a different sector, a different industry. But I think the market all comes down to we're talking about stocks now, all right? We're not talking about cryptos or commodities. We're just talking about stocks. I mean, look at this Apple chart. I mean, you know, you don't need to be a former hedge fund trader or market guru to see this. I mean, look at that. What was resistance here within pennies? Pennies. This stock is worth trillions of freaking dollars. It just shows you how precise things can be if you learn how to read a damn chart. Forget the valuation of the company and academics and what they're saying on CNBC or whatever. Trading is about understanding investor psychology. Why is there support here? Because there are people here who sold. They thought they were the kings when the market went lower, but then it went higher, and they're like, I made a mistake. If it can go back to my price, can I buy my shares back? We're talking within pennies, right? Just to prove it, on this day, the opening price was $217.59. Yesterday's closing price was $218.90. Oh, wait, sorry. $217.13. So we're talking. All right, actually, let me put. All right, I'm gonna do that. All right, so yesterday's close 217.96. All right, 217.96. This day's open 217.59. 10 cents on a stock that is worth trillions of dollars. Why? Well, it's because of psychology. It's because people sold here and they're going to buy their shares back here because they got mad that they moved higher. Forget the news, forget the research. If you're a short-term trader or prop trader, as we call them, just pay attention to the levels. All right. So anyway, that's Apple. This is, in my opinion, in the equity market, the most important thing to watch. Let me just go take a look at the S&P 500 here. Kind of a non-ish day. I mean, I know it was a little bit of a rebound. It was up 1%, but not enough to really make me think that we have any kind of reversion. And as a matter of fact, even though the price was up today, the action over the last couple of days is kind of been weak in the S&P. And let me explain to you why, right? It's kind of these inverted hammer patterns. Again, forget the pattern. Let's just think about what it shows us. Yesterday, the market got all the way up to here, and the sellers pushed it all the way back down to here by the close. Today, we opened higher. We got all the way up here. The sellers are still pushing things down. So, a little bit of a rebound. I don't know if it's enough for me, at least, to think. Maybe you think, and maybe you're right, and I'm wrong. I don't proclaim to, be right all the time. And one of the reasons why I'm good at this is because I can admit when I'm wrong, and that's something that you should learn. Big part of being a trader is understanding when you're wrong and getting your ego out of it. And it's still hard for even people that are successful. But anyway, a little bit of rebound. But after this kind of a bounce, not surprising. Like, look at this. We had this sell for, we had this bounce, right? So let's just talk about what we need to watch. We looked at Apple. Yeah, I mean, Microsoft blasted through support. Even though we had a big day today, kind of a rebound, 1.6%, the closing price was still lower than yesterday's opening price. So that tells me the trend is still going lower. All right, NVDA. Kind of the same thing here, right? We opened here, closed much lower. There's some serious weakness in the tech sector here. I think that this is going lower. Let's just look at a couple other guys here. And remember, this is just a market review. Ooh, look at that. Damn. Market review. I mean, it's pretty obvious what the trading idea is here. Is like pick some of the stuff on the short side. I mean, a lot of our students trade the SQQs. It's the ETF that goes up 3 times as much if the Qs go down. The Qs is basically tech. So if this stuff keeps breaking down, of course, the Qs is going to break down. Massive sell-off here, kind of no rebound. What's that super microcomputer? Was it SMCI super microcomputer? You gotta love that name, super microcomputer. Break-in resistance. Support. No kind of reversion there. All right, so basically, let's face the facts. The tech sector sucks. Let's look at the second biggest sector and the third biggest sector. Healthcare is doing fine. Okay, here's your ascending triangle pattern. As time is passing, the lows are forming at higher prices. Higher lows means that as time is going by, the buyers are getting more aggressive. Broke resistance, had a little bit of reversion. The resistance has converted into support. Let's look at our financial sector here. This is doing okay too. So basically, here's what's going on. It's like I don't know, what the hell is that called? What do they call it? A rebalancing or a rotation? Money is coming out of tech and it's going to these other sectors. So a lot of my students, you might be one of them, ask me like, well, gee, Mark, if you're some big institutional manager and you think the market's going to go down, why don't you just go to cash or why don't you just buy puts? It's not that easy, okay? In the institutional world, people have strategies. Firms have strategies, okay? And the clients of the firms, the people that really run Wall Street, are the pension plans. The pension plans might say, hey, I'm going to hire, Mark's firm out there in Norwalk, Connecticut or Stamford, Connecticut, because I want them to manage equities for me. So somewhere in that contract, it might say, hey, Mark's firm cannot get more than 5% in equities. Cash. Mark's firm needs to be, in equities. It can't get more than 5% cash because the pension plan that hired me, they have another money manager somewhere else that they hired to manage their cash. And it's not, managing cash seems like, oh, well, you just put it in account. No, they have short-term trading, short-term stuff. They try to beat the short-term interest rates. Anyway, so if the money manager hired me or if the pension plan hired me as a money manager to manage equities, that's my job. That's that's what I'm contractually obligated to do. If I get into too much cash, it's going to throw their strategy out of whack because maybe that pension plan says, hey, we're going to only give 10% of our money in cash. If this particular Mark's firm out there somewhere in Connecticut gets to be 7% cash instead of 5% cash, well, all of a sudden my cash is going to be 11%. So basically what it comes down to is this: if you're an equity manager, a lot of times you're obligated. You can't just do whatever the hell you want. So if you think the market's going to go down, what do? You sell the stocks that you think are going to go down the most, and you buy the stocks that you think are going to go down the least. You have to maintain that equity exposure. So anyway, stuff is coming out of tech. It's going into healthcare. It's going into financials. Let's take a look at the industrial sector. Yeah, industrials are hanging out. They're doing okay. Let's look at our consumer discretionary sector. But still, though, tech is in the driver's seat. Going back to our price levels, look at this, right? XLY sells off. Where does it find support? The level that was resistance. I know it's like a mantra. Just tell yourself: levels, trends, momentum. Levels, trends, momentum. Check out Stock Market Jobber. Check out Stock Market Jobber. All right, that's your mantra, everybody. All right, I'll probably be back here tomorrow for some more commentary. All right, thanks for tuning in. I'll see you then. Appreciate it, everybody.